Picture two people saving for retirement. One contributes for 10 years, then stops entirely and never adds another cent. The other contributes for 30 years, 3 times as long, 3 times the total money in. 40 years later, the person who put in just a third as much ends up ahead by over $250,000. Same market, same returns. The only variable was timing. The one who quit early still came out on top. I know that sounds far-fetched, so I'm not asking you to just trust it. Every figure here was calculated before it was spoken. Here's something the finance world rarely says outright. The size of your return isn't what ultimately makes you wealthy. The unglamorous factors, how long you stay invested, who actually controls the money, how big your bets are, and whether you survive the rough years, are what really determine the outcome. These aren't tips. They function like laws. Once you understand them, you can't unsee them. This is the most useful financial insight you'll come across. Not because it's clever, but because the numbers back it up. Start with that earlier example because it conceals something important. The early saver didn't win by contributing more, he contributed less. $60,000 versus $180,000. He won because his money had more time to do what money does best, multiply. Here's the part that defies intuition. We naturally assume that double the time means double the money, and double the money means double the result. Compounding doesn't behave that way. It moves in curves. For a long stretch, almost nothing happens. Then, late in the game, nearly everything happens at once. We expect a staircase. Compounding builds a ski jump. Take someone saving $500 a month at an 8% annual return for 40 years straight. After the first decade, he has roughly $91,000. Modest, easy to overlook. This is the stage where most people give up because progress feels invisible, like pushing a boulder that won't budge. But look at the final decade, years 30 through 40. In that stretch alone, his balance grows by more than $1 million, over 10 times what the entire first decade produced. He didn't increase his contributions or chase a better investment. The only new factor was time. The boulder that barely moved at the start is now rolling downhill under its own momentum. That's the first law. Time compounds more powerfully than money does. It's why the person who started early and stopped still beat the one who started late and pushed harder. He wasn't better, he was earlier. Here's a tool worth keeping, the rule of 72. Divide 72 by your expected return, and the result is roughly how many years it takes your money to double. At 8%, that's 9 years. Over a 40-year career, your money doesn't just double once or twice. It doubles more than 4 times. Start 10 years late, and you don't just lose 10 years of contributions, you lose an entire doubling cycle at the end, the one that would have counted most. It goes further than most people expect. A worse return held for longer beats, a better return held briefly. $10,000 at 12% for 20 years grows to about $96,000. The same $10,000 at just 7%, left alone for 40 years, grows to nearly $150,000. The lower return wins, not narrowly, but by half again as much. The investor chasing the bigger number lost to the investor who simply stayed put. So, the real first decision isn't, how do I find a higher return? It's, how do I stay invested long enough for the return I already have to matter? Time is the lever. Almost everything else is noise. Time can only compound something. So what are you actually feeding it? There are 2 fundamentally different kinds of money, and mixing them up is one of the costliest mistakes anyone can make. The first is cash flow. Money that comes in and goes right back out. Your paycheck, rent income if you're a landlord. It covers bills, the car, groceries. It keeps you going this month, but it doesn't compound because you spend it. It's a river. It only flows while you keep working. Stop, and it dries up within weeks. The second is equity, ownership, the money you don't spend, sitting in things you own, shares in a business, a stake in property. Equity is a reservoir, and it's the only one of the two that compounds because it's the only one you don't consume. The river keeps you alive. The reservoir is what eventually sets you free. This isn't philosophy. It's arithmetic. Wages barely compound. Over a working lifetime, $1 of labor income grows at roughly 0.5% above inflation. $1 of ownership grows at around 7% above inflation. Over 40 years, that gap is enormous. The labor dollar becomes about $120. The ownership dollar becomes nearly $1,500. The same starting dollar did roughly 12 times the work on the ownership side. Labor pays you once. Ownership pays you continuously. This is also why a raise doesn't automatically make you wealthier, and why people can earn more every year and never feel richer. A raise just widens the river. If spending rises to match it, which it usually does, the reservoir never fills. You could climb from a $30,000 salary to $300,000 and still be exactly as dependent on your next paycheck as when you started. More income that gets fully spent is just a bigger river, not wealth. Wealth is only the portion that gets diverted into the reservoir. This is why income and wealth aren't the same thing, and why high earners can still go broke. Compare two people. One earns $200,000 a year and spends it all. The other earns $80,000 but owns $1 million in equity. Ask how long each could stop working tomorrow and still get by. The $200,000 earner, 0 days. The moment income stops, everything stops. The $80,000 owner, drawing down 4% annually, could continue indefinitely. The lower earner is, in every meaningful sense, the wealthier one. That's the second law. Income keeps you alive. Equity sets you free. The whole game is converting the first into the second before you run out of time, which loops back to the first law. The earlier you convert income into equity, the longer it has to compound. How much equity counts as enough? A simple rule of thumb. Take your annual spending and multiply by 25. That's roughly the reservoir needed for a 4% withdrawal rate to cover you indefinitely. Spend $60,000 a year and you need about $1.5 million in equity, not income, equity. Notice what that implies. The less you need to live on, the smaller that reservoir has to be, and the sooner you're free. Cutting spending doesn't just save money. It moves the finish line closer. You've probably encountered this next concept before, even without knowing its name. It's one of the most repeated pieces of math in personal finance because it sounds almost like a trick. Buy a $300,000 house with 10% down. $30,000 of your own money, the bank covers the rest. The house appreciates 10% to $330,000. You didn't earn 10%. Your $30,000 became $60,000. That's a 100% return, 10 times the gain from the same price movement. That's leverage, and most finance content stops right there. I won't, because the lever doesn't care which direction you want it to move. Run the same house in reverse. It drops 10% to $270,000. The loan doesn't shrink. You still owe the full amount borrowed. Your $30,000 in equity is now zero. A 10% decline erased 100% of your money, and that's the gentle version. Factor in 3% in closing costs, and the same 10% drop doesn't just wipe you out, it leaves you owing more than the house is worth. There's a harsher version that can catch people in the stock market, where the lever can pull the rug out before the bottom even arrives. Say you put in $50,000, borrow another $50,000, and buy $100,000 of stock at 2-to-1 leverage. While the price rises, you look brilliant, but the lender has a rule you agreed to, and probably forgot. Your equity has to stay above a minimum threshold. The stock only needs to fall around 29% before a margin call hits. The lender doesn't ask permission. They sell your position at the worst possible moment to protect their loan, locking in your loss permanently, right at the bottom, exactly when patience would have paid off. Someone who owned the same shares outright could have simply waited it out. The leveraged investor is forced to sell and never recovers. That's the third law. Leverage multiplies everything, your gains, and in equal proportion, your losses. It isn't free money, it's borrowed amplification, and the amplifier runs in both directions at once. Everything rests on the collateral, the house, the stock, whatever backs the loan. Lose the collateral, and the loan doesn't forgive you. Used carefully against an asset you understand and can hold through a downturn, leverage is one of the most powerful tools in finance. Used to stretch for something you can't actually afford, it's the fastest way to turn one bad year into a permanent one. The next two laws determine whether you stay in the game long enough for the first three to ever pay off. Most people assume a loss, and a gain of the same percentage cancel out. They don't, not even close. Lose 10%, and you need about 11% to get back to even, manageable, but the math curves against you fast. Lose 50%, and you don't need a 50% gain to recover. You need 100%. You have to double what's left just to break even. Lose 80%, you need 400%. Lose 90%, you need 900%. The required recovery doesn't grow with the loss. It grows far faster. Follow that curve to its logical end. Lose 99%, and you'd need a 9,900% return just to break even. Lose 100%, and no return, no matter how large, can ever bring it back. None. Compounding has one fatal enemy: zero. Every law covered so far is a chain of multiplication. Your money times a return, times another return, year after year. Multiply that chain by zero even once, and the whole thing collapses to nothing permanently. Decades of compounding, equity, well-used leverage, all of it only matters as long as it never touches zero. This is why the size of a bet matters more than its quality. Here's something that tends to surprise people. Imagine a genuinely excellent wager, an 85% chance of winning with a 50% gain when you win. Fantastic odds by any standard. Now put your entire stake on it and reinvest everything each time you win, repeating the same great odds. Do that 10 times in a row, all in each time, and you survive only about 20% of the time. An 85% odds bet wipes you out 4 times out of 5, not because the bet itself was flawed, but because betting it all means a single loss ends everything. Over enough repetitions that one loss stops being bad luck and becomes a near certainty. A 15% chance of disaster, faced repeatedly, eventually becomes inevitable. The mistake isn't misjudging the odds. It's structuring the bet so one bad outcome can end the game. That's the fourth law. The goal isn't to win big once. It's to never be forced out of the game. Size your bets so that no single loss can wipe you out, because the recovery math means the deepest losses are the ones you never come back from. Protect the downside, and the upside takes care of itself. Survival isn't a side note in investing, it's the entire strategy. Which brings us to the final law, the one most likely to spark debate. You've probably heard that wealthy people don't diversify. They bet big on what they know, putting all their eggs in one basket and watching it closely. And that's true. Most enormous fortunes are built through concentrated bets. But there's a condition usually left out of that advice. They concentrate where they have both deep understanding and real control, typically their own business. They're not guessing. They have inside knowledge and a hand on the controls. Concentration is only rational when you actually have an edge, a genuine reason to believe you know something the broader market doesn't. Remove the understanding and the control, and that same move stops being conviction and becomes gambling dressed up as strategy. Here's what that gambling actually looks like, because market averages tend to disguise it. Pick a random individual stock and hold it long term. The typical median outcome doesn't double, doesn't even keep pace with the market. It loses money. Roughly 2 out of every 3 individual stocks end up worth less than where they started. Only about 1 in 6 outperforms simply owning the entire market. Random picking mostly loses. So, how does the market as a whole keep rising if most individual stocks are sinking? A small handful of exceptional performers, roughly 4% of all stocks, generate the overwhelming majority of total market gains. A few enormous winners pull the entire average upward, carrying everyone who happened to hold them. An index fund doesn't win through cleverness. It wins by guaranteeing it owns that 4% of winners, because it owns everything. And before assuming you'd simply pick the winners yourself, remember they're only obvious in hindsight. At the time, the eventual giants looked indistinguishable from the failures next to them. For every company that became a household name, a dozen equally promising ones quietly went to zero. Hindsight makes it look easy to spot. It wasn't. Put those facts together. If you can't reliably identify that top 4% in advance, and the evidence shows almost no one can, including professionals running expensive funds, then concentrating your money is mathematically more likely to land you in a loser. Owning everything is the only reliable way to guarantee you also hold the few winners that drive the whole market. That's the 5th law, and it runs counter to the popular slogan, "Diversification isn't weakness, it's a hedge against your own blind spots." Acknowledging the limits of what you know isn't timid, it's actually the more sophisticated move. This is the real, unglamorous case for a simple index fund. Not that it's exciting, but that it quietly guarantees you hold the winners you could never have picked in advance. Concentrate where you genuinely have an edge. Spread out everywhere else, because the math favors humility. Put the 5 laws together, and they're not really 5 separate rules. They form 3 jobs that work together as one system for keeping money instead of losing it. The first job is momentum, getting money to grow at all. That's the first 2 laws. Give it time and feed it equity rather than income. The second job is structure, determining who actually captures that growth. That's the third law, leverage, which can either deliver the growth into your pocket or hand it to the lender, depending entirely on which direction the lever swings. The third job is asymmetry, making sure you're still standing to collect. That's the last 2 laws. Never bet so big that one loss ends you, and never concentrate in something you don't understand. Momentum builds it, structure captures it, asymmetry protects it. Miss any one of the 3, and the other 2 can't save you. It all distills into 5 questions to ask before putting a dollar anywhere. 1. Can this compound? Is it built to grow over years, not days? 2. Who controls it? You or someone else? 3. What happens if it fails? Do you recover something or nothing? 4. Is the upside meaningfully bigger than the downside, and can any single loss take you out entirely? 5. Do you actually understand it? Can you explain how it makes money and what could go wrong? If you can't answer those clearly, what you have isn't an investment, it's a hope. This was meant to be the most useful financial advice you'll come across, not because it's clever, but because the numbers hold up every time you run them. Time beats return. Equity beats income. Leverage cuts both ways. Avoid blowing up, and diversify everywhere you don't have an edge. None of it is flashy. All of it is true.